Do wealthy people pay lots of taxes?
Yeah, Brian, I'm super excited about this one because I think this is true for you, but I grew up in a household where the common thought was, the wealthy people, the rich people, they don't pay any taxes. Taxes are those things that are left for all of the other folks to pay. And I feel like there's even some of that in popular media today that like certain people, you hear stories about, oh, well, so-and-so doesn't pay any taxes. And so it seems like it's a common thought that the more success that you have, the more black box type access you have to things to get you out of paying any taxes at all.
Yeah, and this is one of those topics. I typically try to defer this as much as possible because it might swerve into politics, and we don't do politics on the show. I feel like that we just got back from podcast movement, and I felt so bad for the presenters, but like the third session on the first day was adding politics to your show. And I'd probably say 65 to 70% of the room actually got up and left. And I don't think it was because they were a different party than the speakers on the stage. I just think that we all get so tired of the politicization of everything. So I'm going to try to navigate this. But here's why we have to cover this is because I think I have a unique perspective. I also grew up in a household where I was constantly told, wealthy people don't pay taxes. Right. They manipulate their way out of it. And I'm going to hopefully cut through some of that, give you the true details on that. But I also have the perspective of that I prepared tax returns for 16 years. I've also been on the journey from coming from humble beginnings just like you, but now I'm in the higher tiers of the tax code. So I kind of feel like that also makes me the type of shepherd or your tour guide to help you understand and cut through how much of this is a narrative and how much of this is the reality of the situation. And, we're going to do this the Money Guy way where lots of data points so that you hopefully gets us away from opinions and conjecture and actually gets you into facts and figures you can use in your own knowledge.
And I think this show actually was born out of an article that came out. Did we figure out when?
Yeah, it was in June.
So this was back in June. This article from ProPublica came out, and this is what it says. It says the secret IRS files trove of never-before-seen records reveal how the wealthiest avoid income tax. So this article kind of got circulated around, and it created a lot of stir and a lot of conversation around, well, do the wealthy people actually pay taxes?
Yeah, I mean, you couldn't not turn on a news program and see the leaked files that made their way onto CNBC, your local news. Everybody was talking about, once again, and it was affirming the wealth envy that rich people don't pay taxes. And that bothers me because, like I said, I had that narrative my whole life. And then I can remember the first few years I prepared tax returns as a staff accountant. I called my dad up. He was alive at the time. And I'd say, Dad, these folks pay lots of taxes. So it made me I become a student
Something
of
is different.
Understanding how is it possible we have the narrative in these articles that come out and then we have the reality for the majority of business owners and service providers who have good incomes. Why would they pay more taxes? So we want to kind of go deeper. I first wanted to kind of dispel some things that are in this piece on, wealthy people avoiding and where this piece kind of went off track in my eyes. And I'll be quick about this. They came up with what they call their, quote, true tax rate. And I call it the not so true tax rate because here's what, I'm just going to read what they did here. They said, to capture the financial reality of the richest Americans, ProPublica undertook an analysis that has never been done before. There's a reason for that.
We know why.
We compared how much in taxes the 25 richest Americans paid each year to how much Forbes estimated their wealth, not income, wealth, grew in that same time period.
So right there, you should have already had some bells going off. If you've taken any sort of entry-level accounting classes, you probably understood there was some mixing of balance sheet and income statement that just got done, some creative accounting and some improper accounting that was just done right there. I'm sorry, keep going.
Well, here's the thing. I wanted to, because it's easy to get lost with rich people because they have a lot of zeros after their name. You get disconnected from the reality of like your neighbors, yourself, and everything. So I brought this down a different way. I said, imagine, and here, let me set this up for you. Imagine you, the person watching this, the financial mutant who's interested. Last year, because of what crazy stuff going on in the real estate marketplace, your house appreciated $200,000.
Which is not an uncommon story for a lot of homeowners out there.
You, because you're like me, you're over 45, you're trying to simplify your life, you want your mortgage paid down as fast as possible. You paid down $25,000 of debt. Some of that could have been student loan interest, credit cards, and even mortgage. You whatever you want it to be, you paid down $25,000 of debt. You saved and invested $25,000 in your 401k and your Roth IRAs.
Okay.
And then the investment value of your retirement accounts appreciated $75,000. And then unfortunately, you lost a relative and you inherited $100,000.
Okay, so we had our house price went up, our debt went down, we saved some money, our investments appreciated, and we got an inheritance.
None of those are income producing items.
That's right.
Everything I just described to you is improved your wealth, but meaning your net worth statement actually went up because of those things, with you paying down debt, inheriting assets, or your assets just getting more in value. But none of it you would have paid income tax on. But according to the way ProPublica did their true tax rate, you would have had $425,000 of income. There's a good chance of, think about a family that could do this. This is probably somebody making $100,000 to $150,000 a year. You would owe more taxes under ProPublica's calculation than you even made in income from your wages and so forth. That's not the best way to calculate this.
It seems like a bit of an unfair assessment to look at how much wealth increased and apply a tax rate to that, because that's just not the way that our tax system is built. That's not the way that our tax system is structured.
Well, I think, and here's something, and I'm not trying to get ahead of myself, but doing the taxes for 16 years, I can remember one of the worst parts of my job was when I would have to sit down with business owners that had crossed into their income, had gotten to a point within their businesses that they owed a lot of taxes, but they didn't know they owed a lot of taxes, because you'll see in a minute why I say there's a crossover point where all of a sudden the tax code really doesn't give you a lot of breaks on anything. And usually business owners and others aren't necessarily thinking about taxes. They're thinking about, how do you grow? How do I invest in more equipment and do this stuff? And then to tell them they owed $50,000 more taxes, $75,000 in addition to what they've already paid. It's the saddest thing when you have somebody having success but then having to do an installment agreement with the IRS because they don't have the liquidity. We'll get into that, but I just tell you there's more going on. And I also felt like ProPublica excluded some key context. Elon Musk was on this list because they took his 2014 to 2018 increase in his wealth. His wealth growth over that 4-year period was $13.9 billion. That's a huge number.
It's a big increase in wealth.
But the context was completely missing from this, is because because here's what they reported. They said, well, Elon actually only reported $1.52 billion of income.
Okay.
And he paid taxes of $455 million. Guys, you realize, do the math on that. 455 of 1.5 billion of income. Elon's paying close to 30% tax rate. That's far from they calculated a 3% tax rate because he applied it to his net worth. But he really was paying close to 30%. So I don't think Elon is one. They're just looking at a point in time and trying to say he should have paid tax on all this. But the reality is there was a lot going on with Elon Musk with Tesla. Specifically, if you look at this period from 2014 to 2018, Tesla almost went broke, completely broke. And, you know, we even had a tweet where, and I've gotten old enough, I can't read this, Bo, from this distance. Read that tweet out.
This is from November 3rd of 2020. Zane said, how close was Tesla from bankruptcy when bringing the Model 3 to mass production? And this is what Elon Musk responded to him. He said, closest we got was about a month. The Model 3 ramp was extreme stress and pain for a long time, from mid-2017 to mid-2019. It was a production and logistics hell. So this thing, even though his net worth over that time went up substantially, he said he was within a month of insolvency, within a month of bankruptcy.
And it's a hockey stick. I mean, if you looked at what happened with Tesla, is that it's all, everybody was thinking, it's this thing's going down the toilet, it's going down the toilet. Oh my goodness, he pulled it off, and the value has just rocket shipped. Literally, with him owning
rocket ships.
We'll keep going. We'll keep it on Tesla because that's something that I think people can understand. And you can see he had close to $1.5 billion of income. So it's not like Elon's not turning this appreciation of his shares. He's actually turning it into wealth, and he's paying his appropriate share of income taxes. But the context was missing when ProPublica chose this window of time.
So we just kind of did the mathematics for you right there and showed you that Elon Musk had an effective, 30% or so tax rate. But there are these stories that we hear. There are these people that you hear stories about. Oh, they don't pay any taxes at all. And I think there is an example of that we'll walk through.
Well, yeah, and I want to be honest, because there are people. There's always going to be outliers to any situation that we can talk about. That's why when we talk about bell curves, there's always you know,
The ones on the far
The
skews.
ones on the far skews. And the next one is like Amazon and Jeff Bezos. I mean, there is no doubt that if you're looking for somebody that's probably on the dictionary of trying to maximize the avoidance of taxes, it is going to be Amazon.
Sure.
And this is one of those things where understand this is the exception, not the general rule. And we want to give you some numbers here. I mean, it's kind of shocking because I have a lot of smiling boxes show up at my house. I know you probably do.
I've got
I think
a ton.
everybody out
A ton.
there, I mean, it's hard to avoid Amazon. And when you hear in 2018 they had 11.2 billion of pre-tax income, but they actually didn't pay any taxes. They actually got $129 million back because of tax credits and other things. That's like,
So I
huh?
think people hear that.
Huh?
That you made $11 billion, and you actually got tax refunds of $130 million. I get it. That doesn't sit well. There's something that seems off.
2019, 13.3 billion. They only paid 162 million in taxes, or about effective rate of about 1.2%. And then in 2020, they had 20.2 billion with 1.8 billion paid, or an effective rate of around 9.4%. They have a history of getting out of taxation, but let's kind of go deeper. Why is that possible? How can they get away with this? This is in this new modern world. Technology companies do have some benefits over the manufacturer company owner in your town or the service provider that's doing well in your town. Because if I asked every one of you, I said, how does Amazon make its money? A lot of you are like, you know,
Smiling boxes, right? Yeah.
The smiling boxes show up. The margins on that stuff is actually not that big. And then you're like, well, okay, Prime and the streaming services, the TV shows, the movies. No, that's not generating a ton either. I think a lot of people would be shocked to find that a lot of Amazon's income or profit is coming from AWS, meaning that their cloud services. I've actually delved into the financial statements. And here's where I think that this is the advantage that Amazon has over the Internal Revenue Service. Is technology is hard to put your finger on, especially stuff that's out in the cloud and so forth, is because it's not like you can point at a plant. It's not like you can look at a product. It's not like you can say, what did you do within our state or within the continental United States so I can tax you on it and know it's right. That's not the way it works. This is cloud-based. Stuff could be stationed outside the United States. And then you have to know that Amazon has a whole team of attorneys that are willing to defend whatever grayness they need to, because this is just complicated. And I think that he takes advantage of that complication to maximize his tax avoidance. You know, it's one of those things. But like I said, exception, not the general wealthy person you know in your community who owns a manufacturing company or a service company, or even just has a great wage because they're an executive. They more than likely pay a lot of taxes.
So there's two different strata there. You said there are the unique, the one-offs, but then most people who fall into that, you know, wealthy business owner or they're an executive, they all are subject to the exact same tax code that all Americans are subject to. And as a quick reminder, in this country, we have a progressive income tax system. If you look at this is the 2021 federal income tax brackets, and you can see as your taxable income increases through the tax brackets, you actually pay a higher percentage of that income to taxes. So for the first $9,950 you make as a single individual, you pay a 10% tax rate. For married, that goes up to $19,900. So on and so forth through the system until once you are a single person who makes over about $524,000, any income above that, you pay a 37% marginal federal income tax on. So the more money that you make, the higher your income is. For most wealthy people, the larger a percent of your income you're going to pay in taxes.
And it goes even beyond that. It's because, yes, it's a progressive tax rate, meaning the more you make, the more you pay in taxes. But there's also, and this is back to that say the business owner that I would do their taxes, and then all of a sudden they'd notice a year where their taxes went up substantially, meaning they went into a higher marginal rate, but then their effective rate ballooned up 5 or 6%. And what typically would happen is that a lot of people don't realize you start losing deductions, you start losing tax credits once you reach a level of income. You know, some of the bigger ones out there, like think about stimulus checks. We've covered this a lot when we were covering the CARES Act and so forth, is that once you made over 75 as a single individual or 150 as a married couple, you don't those things aren't for you anymore. And it's the same thing, another big thing, like you think about the child tax credit. That's a big one these days. Once you make over 240 single or 440 as a married couple, you don't get those for your children anymore. And that's think about every child is thousands of dollars. That cuts against you pretty hard. Kids go to college. We always know it's a huge deduction or a huge credit creator when your kids are in college. American Opportunity Credit. That phases out between 90 to 180, depending upon whether you're single or married filing jointly.
And there are even limits on being able to take advantage of certain types of tax incentivized vehicles. You know, if you make over a certain income level, you can't even contribute directly to a Roth IRA, which is a tax-free savings vehicle that allows your dollars to grow. You can't even do that if your income is over a certain level, or perhaps you can if you have a different strategy, but you can't just put money directly into a Roth once your income crosses over those income thresholds.
And then to close out this part of it, I mean, there are additional taxes that also step in. It's not just the progressive tax code where your rates go up as you make more income. There's also additional taxes that will kick in. A lot of people don't realize, rental property, everybody gets so excited because it's supposedly a great way to save for the future, get passive income, and then you get huge tax benefits.
I get the deductions. That's what I always hear people say.
Until you make over, $150,000 of income. Once your income's over $150,000, those any type of losses you have in rental property have to either be aggregated with other passive losses, but you don't get to take it immediately. You have to kind of just build it up in the background. And then don't forget about the Medicare surtax. Once your income is over $200,000 for a single individual or $250,000 for a married couple, you're going to pay 3.8% on any investment income that you have flowing through. Don't forget the alternative minimum tax. That's just ensuring that you're paying 26 to 28% after you take out all your deductions, or some of your deductions. I won't say all because charity is exempt from that. But then higher capital gains rates. A lot of people would be shocked to find out, your lower income individuals pay a 0% capital gains tax rate, and then it jumps up to 15%. But once you get to a certain level, your income is you're paying 20% on capital gains. So there's another 5% step up there. So all that kind of squeezes it to where there are higher taxes paid by most higher income people. And there's also, this is something that I feel like gets lost in the discussion on this, because we all hear about Warren Buffett. I love Warren Buffett, but Warren Buffett, the one thing that makes me cringe a little bit is because Warren is that do as I say, not as I do in the tax arena, because he will talk about all the time that he'll compare what his effective tax rate is compared to his secretary, and he pays his secretary very well, by the way, so she's in one of the higher marginal rates. Meanwhile, he's using investment income or capital income. He's paying a lower tax rate because it's already after-tax money that's typically invested, and it's just treated differently. Dividends, capital gains, those things are taxed at a lower rate because they are capital income. And Warren will always say that's inappropriate, and then he'll fight an audit for 2, 3, 4 years with the IRS. So it's one of those things that he's a little disconnected on the way he talks about tax policy versus what he practices personally.
So we've talked about some outliers. We've talked about like Elon Musk and Jeff Bezos and Warren Buffett, and then we talked about kind of the way the system is structured. Well, let's look at some actual data, some data points, and this is prepared by the Tax Foundation. And this is what they found in their study, looking at adjusted gross income across the country and then federal income taxes paid. And they found that half of taxpayers pay 97% of total federal income taxes collected. So what that means is that the bottom 50% or the other half of federal taxpayers only pay about 3%. And when you look at the concentration of taxes paid, if you just look at top 1%, right, the top 1% of income earners, they actually represent about 40% of the total taxes paid in this country, even though they only represent about 20% of the total income earned from all Americans earning income in the United States.
Yeah.
So it is one of those things that the higher income earners are paying taxes. It's not like it's something where the top 1% have a 0% tax. That does happen in unique circumstances, but by and large across the board, that's not the way the data actually falls out.
Yeah, I mean, this is the one that blows people's mind when you talk about the fact that the top 50% pay 97% of the taxes, and then specifically that top 1% is going to pay 40% with only 20% of the income. There's a lot of taxes being paid there. And then if you want to know how does this work, what portion don't pay taxes, It varies, and I got to tell you, I hated that this data. We tried to use the most recent data we could find, but this kind of ends at the end of 2017 because I want to see what happened in 2018, 2019, 2020 because we know what has happened with the new tax policies. We've expanded the child credits.
Mm-hmm.
You know, the credits for having the child tax credits have expanded substantially. We had all the stimulus payments that were paid out. This number, without a doubt, I imagine we're probably getting back to like we were in 2008, where you're going to see 40 to 45% likely of the population had zero income taxes paid when you take into account all the credits. So it's this thing, and that's fine. I don't mind that it's a progressive tax system, but it's just let's make sure we're not trying to really hate on the people in your town that are probably paying their lion's share of taxes for no reason, just because there are outliers like Amazon and Bezos that are kind of running amok with the system in some ways.
It's interesting. You said the thing about Warren Buffett about how he pays capital income, right? So he takes advantage. Well, the thought might be, well, that's what all wealthy people do. All wealthy people do that. Well, it's really interesting. Again, this is from the Tax Foundation. They looked at how income is comprised across the top 1% of earners from 1950 all the way to 2017. And you can see what's interesting is wage income, that's just W-2 income flowing through, that is subject to those marginal tax brackets. Ordinary income has actually been increasing. Entrepreneurial income has been increasing, which is also subject to full taxation, plus you have to pay additional Social Security and Medicare tax on that. And the actual capital income, the investment income, dividend income portion of the top 1% of payers has actually been decreasing a touch. So I would argue that for the majority of even folks that fall into the 1%, the majority of their income is subject to marginal federal tax rates, even opposed to capital gain income, capital gains rates. So I think it's a little bit of a misnomer that all wealthy people, the local doctor or the local home builder or the local, fill in the blank in your town, doesn't pay any taxes. I just don't know that the data would completely support that.
Yeah, because people like Warren Buffett that make their money off of the investments alone are more the exception once again, and you see that's a much smaller percentage for most of the 1% how they make their income. Most are just like everybody else out there. They make it from wages, they make it from entrepreneurial income, which are all taxed at typically ordinary income tax rates. So it really does kind of close the loop on the narrative. And I want you guys to understand this because what I like about this, we're in a progressive system where you pay more the more you make, but also want this to be a liberation moment for you because this ties into that same narrative I was given as a kid, is that the system is rigged against you. The wealthy don't pay taxes. They're totally working against you. Don't let somebody put that on you. Guys, you can do it. You can go from zero to be a 1%er in your lifetime if you will just practice some of the things we share. We both are examples of that, coming from very humble beginnings, coming from the 0 to the 1%. And I want you guys to do it too, because that's my biggest goal with the Money Guy Show, is to create the abundance in your financial life, whatever version that is, because there's lots of different paths, that you get the best version of your financial self and you feel really fulfilled and know that the system can work for you too.
And here's what we're going to do. We're going to keep loading you up. Because again, one of the beautiful things, it's a weird thing to say, a beautiful thing. One of the interesting things about our tax system is that tax evasion is illegal. It will get you arrested. It will get you Al Capone. But tax avoidance is highly encouraged. So if you are willing to do a little bit of extra research, go the extra mile, educate yourself, listen to the Money Guy Show, we're going to show you even where you are, whether you are a 50% or a 75% or a 1% or a 0.1%er, there are ways that you can minimize your tax bill. And so if you have questions about how to do that, get them in the chat right now. Because one of the things we love to do is we love to answer your questions and load you guys up. So right now we have the team out on the periphery. They are getting the questions in here, and we want to make sure that we're helping you take your finances to the next level. All right, here is the first question. This is from J.L. Bryan. He wants to know, based on your outfit today, based on your attire, are you heading to Margaritaville after this? Because it looks like you wore your beach shirt today, and I think it looks fantastic.
So this doesn't count on.
I'm not going to count this as a question, but I figured
what's interesting.
We give the
I
people what
walked
they want.
out with this shirt on, and my wife goes, "Oh, I kind of like that." And I was like, "Yeah, it was kind of hidden in the back of the closet. I had forgotten I had this shirt." So I threw it on. I was actually going to just wear a white shirt with black dots on it. But then I saw this one buried in the back, and I was like, yeah, we're getting close to Labor Day. Won't be too far in the distance. Let's get a few more of those floral shirts going before I can't do it anymore.
And I love it. As soon as she said, "Hey, I kind of like that,"
Oh,
you're
no,
like,
no,
"Oh, I'm going to wear that."
I will tell you, if my wife ever says, "Hey, I like how you look in that,"
I'm going to wear it over.
I'll
You
make
wear
it
it over
to
and over
where
and
she,
over.
hey, why don't you mix it up a little bit, because you ran that into the ground. Because I am bad about that. If she gives me any compliment, I will
Continue to do that thing.
She could really take advantage of me to make me look like a complete clown if she wanted to, because I'll fall prey to it every time.
So, JL, I hope that helped. All right, so this first question, this is actually a Facebook question. This is from Rena. Rena said, I sold my house, and I'm getting ready to put it into the market. So first of all, congratulations. If you are a home seller in the market that we're seeing in this country right now, in most real estate markets, odds are you've done very, very well. So congratulations for being able to sell. And this is the question. Should we go 100% in? I've sold my house. I'm going to invest. Should we do 100%, or should we dollar cost average over a number of months? How do I think about that? So it sounds like they sold the house. They have some proceeds. She didn't say if she needed to go buy a new house. Let's assume not, right? Because she's talking about investing that money, because certainly she knows if she were going to use those proceeds to buy another house in the next 3 to 5 years, she would not invest that, because you always have to, anything you're going to use in the next 5 years, we want you to keep out of the equity markets. But assuming it's money she should walk away from, is the best strategy to invest all at once, 100%, or is the best strategy to dollar cost average? And how do you decide, and when does it change? And if I do the dollar cost average, how long should I do it for?
Yeah, we've covered this, and it's worth kind of recovering, because there is a lot of things going on with real estate right now, and people are making multiple six figures off of the equity in their house. We know from all the research that definitely markets make money 80%. 8 out of 10 years, markets are up. So just by that sheer stat alone, lump sum investing is better on paper, because, hey, if we're going to make money 8 out of 10 years,
more often than not,
let's get that money working as soon as possible so we can start growing it. The fear that's whispering in your ear when it's a huge sum of money, when we're talking about once in a lifetime or life altering, very material to your financial life, is, yeah, but what happens if I'm part of that 20%, and then not only is it part of that 20% where it's 2 out of the 10 years the market goes down, but what if it goes down 25%? What if it goes down 30%? That would kind of make me devastated to know this lifetime money comes in, and then I lose 20-25% almost overnight in a month or two. That would really not only financially hurt me, psychologically and emotionally probably have some scars as well. Sure. So we've come up with, and this is, like I said, if it's a smaller sum of money, get the money to work as fast as possible. But we see it all the time with proceeds from a large house, selling some land, or you sell a business, or you have a lump sum that comes your way. There's nothing wrong with dollar cost averaging over 10 to 12 months. The research shows if you do it within 10 months, your opportunity cost from dollar cost averaging versus lump sum is actually pretty minimal. And then even if you look at the difference on a 10-month to 12-month, the long term, when Vanguard did their study, I mean, we're talking about a very small difference in performance, but I think that's what I love about finances, is not only the math of the calculation, but it's also the emotional and behavioral side, which is so important, because us humans are not efficient beings on the way we make decisions. I think it insulates you tremendously from that what if, because think about the good news of you invest this huge lump sum with dollar cost averaging, market goes up. Yes, you left some on the table by DCAing, but since you're doing it so quickly, the long-term opportunity cost is very small. But if the market gets crushed, it also gives you the opportunity to be opportunistic with your dollar cost averaging. Because think about it, right now, the problem we're fighting with people, or the concern people have, is markets are at all-time highs. There seems like a lot of weird things that I can't control, geopolitical, the pandemic. How do I do investing? What I like about dollar cost averaging also is it lets you create a systematic plan that takes the emotion out of it. But then if we went into bear markets, period, if the market lost 20% while you're dollar cost averaging, there is nothing that says that then you can't use that analytical information to become opportunistic and make it a dynamic dollar cost averaging where you accelerate and buy even more with things down. And I love that added flexibility.
I think that's great. You want to riff for a second? I have a question that you kind of made me think of, only because I'm hearing this with a lot of colleagues. And I imagine a lot of our audience has the same question because we see the website submissions come in. Real estate's done really, really well right now for most folks. A lot of people have seen the value of their homes increase. Even folks that have only been there for a year, 2 years, 3 years, if you're in one of these white-hot real estate markets. And so one of the things that I'm hearing people say is, hey, my house has gone up $50,000, $100,000, hundreds of thousands of dollars. Should I sell now, go ahead and capitalize on that, and maybe I'll just sit on the sidelines for a while? Should I sell now, sit on the sidelines, and wait for the housing market to drop, or rent and then do that? What are your thoughts on that? Is that something somebody should consider? What are perhaps the downfalls of somebody thinking they can capitalize on that?
Look, it is a great opportunity. It's nice knowing something that traditionally is considered non-liquid is actually quite liquid right now. Real estate, you can pretty much get it under contract very quickly. But the words that got whispered in my ear, I feel like just mentally kept playing out as you're asking that question is begin with the end in mind.
That's right.
And the ability to sell your house easily and make a great premium on it is only half the equation because at night, think about the fact your house is providing you shelter. It's where you lay your head at night. It's where probably your spouse and your children are there with the puppy dog and any cats that you have. But you know, if you sell, you still have to have a place to shelter all those people that are part of your family unit. Where is that going to be? And that's why I say you have to begin with the end in mind, because if you sell your awesome house, make lots of money, make multiple six figures, because I see people in my neighborhood, I kid you not, it blows my mind that houses were built 2 years ago that people are making $400,000 and $500,000 above and beyond what they paid.
It's unbelievable.
I mean, so and that might work out great, but here's the question that always comes to my mind:
Where are you
going to
live?
live? Because this only works if you have the unique arbitrage situation where maybe you're moving from a high cost of living place to a lower cost of living place where you can sell high and then go get a lot of value for your purchase. But if you're staying in the same community, what are you going to do here? Because you're going to, yes, lock in that profit, but you either have to go rent or you have to go buy something. And typically to buy, you're going to end up going bigger and paying more. And that doesn't seem like the greatest situation. And then I always think about the fact of if I sold and then sat on the sidelines, how does that work? Now, I have some clients that are doing that, and they're going to watch this, but they're also real estate. I consider them quasi-real estate professionals in the way that they've made lots of money through rental properties and other things. So I'm going to defer to them, but it is one of those things I think even they are questioning, hey, what's the timing of this? Because I had no idea that this appreciation or inflationary pressure was going to last as long as it has. And then you're also noticing, because I think a lot of people are waiting for the shoe to drop on interest rates, because they know if interest rates go up on mortgages, there's a chance that will, that will flow down to the housing market. But the federal government has every incentive of keeping interest rates super low because they have so much debt on the balance sheet. It's a weird situation.
It's one of the things, here's one of the ways that I try to curb my psychology, because right now in my neighborhood, there are houses going under contract at just astronomical prices that don't make any sense. And it's real easy for us to fall into the trap of, ooh, well, if we sold our house, man, we could make this much money over such a short period of time. One way that I curb that, one way about myself, is every year my wife and I, we do a net worth statement where you show what we own, what we owe, and that way we're kind of on the same page. We realize if we're working towards our goals. For my personal use asset, which my house is, I value it at what I paid for it a couple years ago. So even though right now the market value might say it's way up here, so that I don't get excited and give myself a whole lot of credit for having all this stuff appreciate and feel like I'm oh so wealthy, I value that use asset at the value that I paid for it. So the only way that my house is making my net worth go up each year is as my mortgage payment is going down. That helps my psychology a little bit.
I'm smiling because I'm just visualizing all the comments from everybody telling you you're crazy for doing that in the comment section. Because look, but it is going to help you. I do the same thing. I benchmark that from you. I like it because it lets me, when I do my annual net worth review, it lets me see how much I'm actually building in assets that can work just as hard as I do with my back, my brains, and my hands, which are my investment assets, which, your use assets like your real estate, your primary residence, you have to really sell and downsize to actually turn that into usable money
actual
for your
wealth,
financial life. And that's going to happen naturally. But I think there's a lot of people, they do what I call go-kart math, and you need to go back in our archives to see why I call it go-kart math. But it's one of those things where they daydream with the fact that they have all these extra hundreds of thousands of dollars, but that's the lion's share of their net worth. That's not what you're trying to build. The house that you live in shouldn't be the driver of what's creating your financial independence. It's just that's a kind of a, hey, I got an extra because of my use asset. I actually appreciate it. I want you to have the behavior and the skill set to be a financial mutant where you're building wealth automatically through your monthly savings and investments.
Love it. Love it. Thank you for letting me go on that sidebar. All right, this next question is from Jeremy. Now, Jeremy says, the Bogleheads recommend saving 25 times yearly spend as a retirement goal. I believe the Money Guy's recommendation is 10 times. Can you help me understand why your recommendation is lower? I want to clear something up. I don't think that our recommendation is 10 times your living expenses for what you need for retirement. Our recommendation for what you need for retirement is how much you need to retire. We tell you that we think when you're in the accumulation phase, we want you to focus more on your savings rate. Am I saving 20 to 25% of my gross income for the future? But then when it's time for you to actually pull the plug on working, when you actually decide to exit the workforce, we think rather than it being a multiple of your income or a multiple of your expenses, you need a very customized retirement plan that will tell you, yes, I have enough money to live the life I want to live for the years that I have remaining, because it can be affected by so many factors. The types of accounts that you house. Do you have pension income? Do you have other sources of income like real estate properties or business interests? All of those things will affect whether you can retire with 10 times your expenses saved up, or if you're someone that needs to retire with 30 times your expenses saved up. We like using grenades in the accumulation phase, but man, when it gets to actually retiring, actually stepping away, we think you ought to use a scalpel, and it should be laser precise.
This question cracks me up because it's questions like this that make me realize all my buddies, I'm always amazed when they know all these sporting stats. Like you go play trivia and they can tell you, who was the second baseman for this, championship team. They can tell you who leads in RBIs. I don't know any of that stuff. But then you read this question and I'm like, oh, this is where my nerdiness lies. Is because when I hear Jeremy gave credit to the Bogleheads for the 25 times expenses, but y'all realize what that actually is. That is just reverse engineering the 4% safe withdrawal rate from the Trinity study, because if you take 100% divided by 25 years, it comes up to the nice number of 4%, a la the 4% with safe withdrawal rate. You've probably heard us talk about, and I do this because I mention them together, is you could use a 5% safe withdrawal rate, and that's essentially the same as 20 years of your living expenses. They're one and the same. And just to correct what Jeremy said, once again, to also tighten up my nerdiness on this to show that we do a lot of reading, that 10 times number is actually a Fidelity number. Fidelity uses that number, and we do, sometimes when we do the by age series, we will use Fidelity's research because it's another source to kind of throw into the calculation in addition to the 4 or 5% safe withdrawal rate. But Bo is exactly right. I think just like we talk about, it takes 10,000 hours to develop your expertise in your profession. There is also another 10,000 hours as you're in your wind down phase to become an expert on how you're going to do retirement well. And part of that building expertise towards retirement is doing Monte Carlo simulations, trying to break it, stress test it. It's not you using a benchmark. The benchmarks are used while you're developing or building your assets. When you're ready to land the airplane, guys, you don't want a benchmark. You want to make sure something that is custom to the altitude you're at, what your goals are. All this stuff needs to be custom, and that's why you need to do a true retirement plan as you're approaching, especially within the 5 years. That's the other brilliant part of the abundance cycle. We know we can give you so much free advice, help you build your level of success, but at some point you're going to get so complicated, so sophisticated that you're going to need to go custom and take the relationship to the next level, and we're right there, open arms, waiting to help out with all those analysis.
Love it, love it, love it. All right, this next question is from Chris. Chris said, assuming no special fees are incurred, Are there any major cons to leaving your 401k at your previous employer's provider if they allow it, and being fragmented versus rolling into the new 401k of a current job? So when you leave an employer, we really have sort of three options. You notice I don't say four. We have three options of things that we can do with it. We can either roll it into an IRA rollover, which has some stuff that you'll talk about. We can leave it where it is in the 401k, or if we're going to a new employer that has another 401k plan, we can roll it into that 401k plan. You notice I did not say we cash it out because that's never an option. Don't do that. That's not good, especially if you're under 59 and a half. So how do you decide what you do, and what are the implications with each of those three choices that you walk through?
Yeah, I mean, let's go through those. First of all, you're spot on. Don't take the money. That's a big mistake. That's not financial mutant territory when you're taking distributions before you've retired. That's a disaster. Your future self will, instead of hugging you, giving you the big bear hug of excitement, and thanking you, they're going to basically kick you in the knee and be like, how dare you undermine your retirement? So that's no-go territory. Bo mentioned, the easiest action is, hey, especially if you have a rocking good 401k with one of the big ones. I mean, if you work for a Fortune 500, more than likely you have like the Fidelity, the Vanguards, those type of 401ks where they're low cost, have great access to index funds. So you're feeling really keen about all the opportunity there. Yeah, you could leave it. I mean, there's a good chance you could leave it there. The only downside to that is that the further the years you get away from your past employer, the more you fade on access points, paperwork, because even HR issues and other stuff. Now, sometimes that's helped because it's a big national provider like a Fidelity or Vanguard, but even those plans sometimes do have custom paperwork within HR departments. So that's always the problem. Plus, when it's abandoned or left, you have to make sure you're conscientiously keeping up with the management or watching it, because you don't want it to be forgotten. I mean, some of the things that drive me crazy is when somebody brings us an old 401k and you could tell this thing was invested in 1997.
Because it's all the top funds of 1997.
I mean, but it never got updated. So you don't want, just because it's left at your current employer doesn't mean it gets neglected. If you roll it over to your new plan, that's great if you've gone to now one of these really top tier plans that, like I said, are low cost, good index funds, great features with the Roth IRAs and so forth. It's a no-brainer to kind of just bring it over so it's all fresh, consolidated, simple. But sometimes a new employer might have a lesser plan than your old employer, and that would be on par for keeping it back with the old one. And then that third option you mentioned is the IRA rollover. The reason, look, we like it in retirement plans because they do allow the backdoor Roth conversions, because ERISA money, meaning 401ks, 403bs, 457s, don't account against that whole backdoor Roth conversion strategy. But there is some downsides to it, in the fact that you're going to like, when you get closer to retirement, being in an IRA rollover, because you get complete control over the investments, whereas you're always going to be constricted to the investments that your employer offers you when you're in their plan. They set the rules for you. And then you're also, this is going to become important because of why you want to be able to specialize your investment choices, is I love index target retirement funds, but one of the things I tell you, once you get over $500,000, $600,000, tax location is going to become very important for you. Do you have your money in tax deferred, after tax, meaning like a normal brokerage account, or is some of it tax free like Roth? You want to start moving your pots of money around on the different types of investments to be as tax efficient as possible. Sometimes that's easier in an IRA rollover, and plus you have access to do, if you wanted to get access earlier, you can annuitize, you can play. But then we get into 401ks can have 55. It gets complicated, and that's where you might need to take the relationship to the next level on some of those complexities.
And what I think is interesting is the answer is not always the exact same. You may have left one employer 5 years ago and made one choice. Well, then when you leave that employer now to a new one, you might make a completely different choice. Because remember, every time you have to kind of go through this analysis of your three options, not the four options, just the three options, to see what makes the most sense. And we've had it before where a client, we may have decided, because they were just working for small employers that had insurance-laden plans, so they might have had 3 or 4 401k plans, but they finally get to like one really, really good one, and then we consolidate all into the good one, because it has something like a Schwab plan with a PCRA option, or a Fidelity plan with a brokerage link option. it changes through time. So make sure you are constantly revisiting and reassessing what makes the most sense for you. All right, this next question is from Thorian.
Keep going, and maybe one of the seven will be right.
This is what Thorian said. The 654 student loan rule, if you remember, that's the rule that we came up with for student loans. If you're in your 20s, you should not prioritize prepaying debt that is below 6%, in your 30s, 5%, in your 40s, 4%. That's kind of the tiered structure that's based on the equity risk premium and how the power of your dollar changes through time. The 654 student loan rule applies to tackling it aggressively, but what about making double payments with the most cash flow still going to investing? I'm in my 20s and my student loans are effectively 4.75%. This is what he's asking, saying, okay, well, what if I want to do both? What if I want to keep investing, but I'm still going to pay extra on my student loan? I think this is a really good place to talk about. A lot of times when we do analysis on the show, Brian, we talk about prepaying mortgage or paying off student loans or fill in the blank. We're talking about a marginal decision on the very next dollar, right? So he's saying, hey, I'm doing all the things you're doing. Does that make it different? Well, we're just talking about optimizing, right? You want to talk about that a little bit?
Well, first, back to his specific situation. If his interest rate's 6.75%.
4.75.
Oh,
4.75.
I misheard. But this, you just hit on something that I think is very important. I had a whole Twitter exchange in the last few days. Just like Dave Ramsey has Dave-ish, meaning people get so excited about paying down debt that they will carry on that behavior to their detriment almost, in the fact that once they pay off the bad credit cards or the student loan debt, they then start tackling low interest mortgage debt instead of doing the Roth IRA. That's Dave-ish, because that's not what Dave Ramsey recommends. Well, we have a new thing that's just been kind of birthed, which is FOOish.
FOOish.
Yeah, I mean, we do have FOOish, whereas people get so excited about the power of investing, especially when you come through a few years like we've had where the markets are making greater than 10% each year. You get so excited about it that you're like, why would we ever pay down debt when I can make 10% greater on my investments and I got this debt over here? But I say that's FOOish, because it's missing a key component of flexibility that we build into the financial order of operations, which is anyone who has made it through the 8 steps and is actually on step 9, which is low interest debt, meaning you've already got your cash reserves, you're already got the debt under control to a degree, meaning the high interest side of it, and you're already saving 25% of your gross income. Any money above and beyond that, I give you the flexibility. Even if you're under 45 years of age, pay down some of the interest debt, because if it helps you sleep better at night, I am perfectly fine with that. I mean, that's why I do think there's 32-year-olds that can pay off their mortgage and still not be working against the financial order of operations, because they went ahead and played the ground, they respected the opportunity cost of every dollar in their army of dollar bills by investing it. The same thing happens with student loan debt that's low interest. Yeah, go do the double payments, as long as you're paying respect to saving that 20 to 25% of your gross income. You're on firm footing with that decision making.
And I'm not going to fight you on that. That's FOOish. I like that. Because did he say how old he was? Did I say how old he was, Thorian?
Well, I think that
he said he's in his 20s.
There are so many paths to abundance.
That's right.
You need to put this flexibility, because everybody's risk profile is a little different.
Sure.
And we're already making some people uncomfortable that they feel this weird itch when they owe anybody anything. And I'm just telling you, you have to have a differentiator to know where you are in navigating this well and also paying respect to the long-term risk.
Okay, I'm not going to fight you on that. I'll let that one go.
Yep.
All right, here's the next question. This is from Jay Tart. He says, question, I find myself less than 5 years from retirement with 83% of my funds in traditional 401k and IRAs. So majority of his portfolio is pre-tax. I project my taxes will not be going down dramatically with pensions, Social Security, and withdrawals. What should I do? So it sounds like what he's saying is, hey, I'm in this position where I'm 5 years away from retirement, and I am what's known as being retirement rich. Every dollar that I want to get to is going to be fairly cost prohibitive, because I'm going to have to pay ordinary income tax to pull that dollar out. Are there things I should be thinking about, or the things I should do if I don't feel like my tax rate in retirement is going to drop?
Yeah, this is one, by the way, just experience share. It breaks my heart. We've done shows on people who are retirement rich, but it feels like life poor in some ways, because nothing's worse than it's time to replace the cars. You want to just buy, a nicer car outright with cash because you're worth several $1,000,000 on paper, but you have access to not that much liquidity to actually pay cash for the vehicle. We've seen this happen. It's a weird dilemma. So I'm going to speak about this in several different ways. First of all, you have time. You have 5 years. Start looking at those the three buckets. Your after tax, which is your taxable brokerage account, your tax deferred, which you got plenty of since 83% is in those tax deferred, and then your Roth, which is tax free. Let's try to start building that bridge of getting your after tax money up so you can actually have some money to live with. That's super important. And then the other thing, I don't know if they shared their age, but one of the things I'm always thinking about, well, the way you rectify this is through potentially a Roth conversion strategy. Once you do retire, if you have enough time from retirement age to age 72 when you have your required minimum distributions, those are the two big planning opportunities that kind of poke up immediately when I hear this question. But I would use this time to definitely start building up the after-tax bucket of your investments and savings, because you need liquidity, because there is nothing worse than ever you feel held hostage by the higher tax rates that you can't live your best retirement life because you're paying so much in income taxes on every decision to pull money out. That is a big problem, and you got to start backfilling. How do you have access and flexibility and tax diversification to pull those assets?
And I think it's interesting, depending on your circumstance, the answer might be to build up your after-tax bucket. Maybe the answer, again, depending on your circumstances, is to begin building up a Roth bucket, your tax-free bucket, maybe shifting your 401k contributions. If you are 5 years away from retirement, this is one of those times where you want to make sure that you are doing what makes the most sense for your unique and specific financial circumstance. So that probably is a great time to think about reaching out to a professional advisor. Your landing gear is not exactly down yet, but you can see the runway. You know what you're moving towards. And so some of the decisions you make here 60 months away from your exit from the workforce can have some pretty significant impacts, especially on the first few years of your retirement. So I don't think if you are 5 years away and you are trying to figure out how to shift your portfolio or shift your strategy, it might be a really great time to get a second opinion, second set of eyes, to look over your shoulder and make sure there aren't things that you've not thought of that you should be thinking of. This next question is from Alex. Alex said, hi, my employer gives us our 401k match at the end of the year in company stock. Should I transfer it to my target retirement fund? And then his second question was, do I need to worry about taxes or anything along those lines? I feel like we don't see this as much, Brian, but a lot of times employers, when they do a matching contribution, you put in $1, they put in $1, they won't just put cash in, they'll actually match you in company stock in the plan. And so his question is should I diversify that? Should I, think about shifting that to my target retirement fund?
History lesson, you used to see this a lot more. I mean, we're from Atlanta originally, and there was a lot of big public companies. I won't say their names, but they actually had a culture that you would get in trouble if you sold your company's stock. They would come around. They actually tracked who was owning stock, who was selling. After the Great Recession, in the 2008, what happened to the financial markets, a lot of that from the federal government level, they've kind of let it be known, hey, don't be creating a culture that your employees can't diversify their financial lives from their working capital lives. So you don't see as much of that, but you do every now and then run into this type of situation Alex described, where he does get his employer match through company stock. And here's what I would share with Alex is that, first of all, and you have to do this in a little skeptical ways, because most people who work for companies, especially on executive level or higher level, you think your company's great.
Yeah, you feel great about it. You're bullish.
Because I am going to give you the flexibility that you don't want more than, danger territory is 5%, and then you don't want to go over 10% of your investment capital being tied to the same company as your working capital, meaning your human capital, and how you spend your hours. And that's kind of the threshold. So if you look at your retirement plan and you say, oh man, I'm getting between 5 and 10%, because the good thing about a 401k is typically you can sell without generating
Yeah, you can sell inside
capital
no
gains.
taxes, yeah.
Now, look, I want to be specific here. There is some unique things with 401ks and company stocks that we would be wrong if we didn't share this with our financial mutants.
So glad you brought that up.
I want you to kind of give them a little deeper dive on this, because this is important.
Yeah, so maybe you're hearing that and you're thinking, oh man, I've been buying company stock, or I've been getting matched company stock for the last decade, and I just heard the Money Guy show tell me that I ought to go diversify. I'm going to go sell that. Wait, hold on. There is a very unique treatment called net unrealized appreciation that if you do have a lot of company stock that's housed inside your 401k and you are thinking about retiring, or perhaps you work for a company that's done very, very well, be careful selling all of that stock and rediversifying, because there's a very unique and sort of once-in-a-lifetime opportunity where you can capitalize on the net unrealized appreciation of that stock, which basically allows you to turn a big chunk of your 401k that's ordinary income money into long-term capital gain money potentially. It is a little complicated and very nuanced, so you want to make sure that if you are someone who has a lot of company stock and that company stock has done very, very well, first, I'd go Google net unrealized appreciation so you understand exactly what it is. And then I would seek professional advice to say, hey, is this something I ought to think about? It's different if you're someone who's 20 years away from retirement versus you're someone who's 2 years away from retirement in terms of how you think about that decision.
What I love about doing this show is that things like that, throwing out little nuggets, will show you why we're not your grocery store type of financial advisors. Because, guys, is once you reach a level of success, that's why we can just give it away. You're going to need somebody to help you navigate some of these more complex decisions, because you don't want to screw it up. And that's what we're here for. I mean, that's why I love the abundance cycle. I love that we can give away so much free information, is because you can keep things as simple as you want, but complexity with success, it just shows up one day. So we'll be there to kind of help you navigate that when that time comes.
So this next question is from Jordan. Jordan said, what is the best place to park money set aside for deductible? So it sounds like Jordan is in, I'm guessing, step 1 of the financial order of operations. Jordan said, savings rates are so low, I'm thinking about short-term bond ETFs. So I'm step 1 of FU. My savings account's not paying me anything. Should I do some bond ETFs? So maybe I try to beef up the return of my step 1 of the FU.
You know, Jordan, this is the weird thing, is that historically you'd be like, hey, that's a great way, because I'm willing to take on a touch more risk. I don't want to go into the equity marketplace, but I'm willing to go a little more risk, like maybe do bonds so I can get a higher interest rate, and you know, so I can hopefully get a better rate of return than what cash is doing. That makes complete sense, but there's a problem. There's some weird interest rate distortion things going on in the bond marketplace right now. And look, I don't want anybody to mishear this and think I'm saying that bonds are going to crash like the stock market will. They don't have the same risk, but duration risk and then interest rate risk, there's still risk associated with bond investing too. And even short-term bonds are going to be in a weird state if interest rates start going up. So even a short-term bond fund could bear some risks that you would be really disappointed in if you needed this money in the next 2 to 3 years. So I would encourage you, and it is so unsexy with cash being so low on its yield, but I would probably do like an online FDIC insured savings account. I mean, some of the biggest providers that you see at the top of the list when you go to bankrate.com is somebody like an ally.com. But do your research, and then I know you're trying to maximize yield, but be careful getting into things that are priced daily and have, a valuation impact from interest rates or market risks. It could be a concern.
So I'm not incredibly well versed in like military terms, right? So if I screw something up here, I just want you to let me know.
You think I'm going to be your backstop?
Maybe Dr. Ron will come in here and straighten me out if I'm wrong on this. But like, in the armed forces, different people have different jobs. Different soldiers, right, have different jobs and responsibilities that they carry out. Well, remember, when you're working through the financial order of operations, you're building your army of dollar bills. Every single dollar in your army is a soldier that has a purpose. One thing you have to remind yourself of is when I'm in step 1, deductibles covered, those soldiers, their sole job is to keep me out of the ditch. They are not my growth soldiers. My growth soldiers are the ones that I'm doing Roth and HSA, maxing out employer retirement accounts, hyperaccumulation. It's okay if I'm not maximizing every single bit of return that I can get out of my deductible covered soldiers or even my emergency fund soldiers, but they still serve a vital, vital role in your army. So don't forget that. Don't start putting everything into the growth bucket and leave yourself naked and exposed, because they are there to keep you out of the ditch. So I know it's not fun and it's not exciting, but it's necessary if you're going to follow the correct path to building financial independence. I don't think I said anything. That's right.
The only thing you should have said, financial order of operations. I mean, because that's exactly what Jordan was referring to. And I think you just have to respect that portion, and that's why it's a smaller portion, is to keep you safe.
That's right. This next question is from Sergio. This is from YouTube. Sergio says, if you're in the 32% to 35% bracket, is it better to just fund regular 401k versus Roth 401k? So how can, if he's in the 32 to 35, how can we help Sergio decide which one to fund? And then maybe if someone's not in that bracket, how would they decide?
Yeah, I mean, always when somebody's trying to figure out, do I do traditional, do I do Roth, you have to answer a few questions. Mm-hmm. You have to ask yourself, how old am I? What will the tax environment be like when I retire? And do I think tax rates are going up or down? Just a few reading the tea leaf moments. I mean, got a lot of debt in the United States. I think the whole world has a lot of debt right now. So that's probably going to lend itself to higher tax rates in the long term. But then the optimistic side of me is like, man, but young folks, they have the ability for compounding growth where your money could be tax-free by putting in that Roth. That's a really powerful thing. So you have to balance those two things that are in conflict. Yep, that's right. Elbow just fell right off. There's two things that are in conflict there that you have to balance. And we've tried to give guidance in the fact that I always think about when you retire, usually you can manipulate legally, meaning you're not cheating your taxes. You're just structuring your taxes where you can minimize to your tax bill as much as possible. In retirement, it gets easier because you don't have your peak earning years. Mm-hmm. You can choose how much you want to pull out of your retirement accounts. You might have some after-tax money that's not going to have taxes. You might have some Roth money. So you can figure out what you want your income to be, and you legally manipulate the tax code. If you're that type of person, maybe you can get your rates down below 25% in retirement. And that's that situation. Yeah, I think somebody who's paying 32 to 35%, you're going to probably like having the traditional savings, so you get the tax deduction now, and then hopefully can manipulate your taxes lower when you're retired. Where it's gray zone, so anybody who's young and pays under 25% taxes, no brainer. Go ahead and do the Roth.
Yeah.
I think people who make between 25 to 30%, effective taxes, it's kind of gray zone. That greater than 30%, which is where Sergio is, yeah, that's the ones I think that game it and see if you can take advantage of a situation there.
Now, what I love, and Sergio, you specifically asked about 401k, and in most circumstances, you didn't even make a decision one way or the other, either Roth or pre-tax. I mean, maybe you split them if you're in that 25 to 30% range, but we don't love the idea of only building pre-tax, only building Roth. We want you to do both, right?
Yeah.
So maybe you max out your pre-tax 401k, but then you also max out your Roth IRA, or maybe you do backdoor Roths. So that way you can build up both of those tax buckets. Because maybe you're a really high income earner now, and you say, you know what, my lifestyle has got accustomed to this. Even when I retire, I still want to live this kind of lifestyle. Well, even if you still live that kind of lifestyle, but you've built all three of your tax buckets well, you could still be in a lower tax bracket because you get to control your tax situation based on where you pull your dollars from. So so long as you can control it, we really like the idea of building both pre-tax and Roth assets wherever you can.
Yeah, and primarily through it, because if you're in the 32 to 35% tax bracket, you're probably not able to do traditional Roth contributions, but you can look into, see if you have the right account structure to where you can do a Roth conversion strategy.
Love it. All right, this next question is from Kyle. This is a Facebook question. It's one I feel like we get a pretty good bit, Brian. What is your opinion on income investing? I really like target index retirement funds, but having consistent passive income sounds appealing. I'm assuming he's talking about like dividend type holdings and that sort of thing. Is Core and Explore approach a good option for a young investor? Lot in that question, I feel like.
Yeah, and it ties back once again back to my investment history nerd stuff. Core, what did he say?
Core and Explore.
Core and Explore is to me the same as we've always heard it as core and satellite
satellite
approach,
or
where
spoken
you'll
wheel.
have spoken will. I mean, you see all kind of terminology where you have your core investments, which is like the S&P 500, and then you can go and add different sweeteners, whether it's international, whether it's technique, if you want to go sector plays, all that's there. I want it because there's so many questions there. I want to bring it back first to dividend investing because I see a lot of people saying, "Hey, I'm on purpose seeking out high dividend stocks so I can replace more and more of my income." And I don't have a problem with dividend investing, other than you get to a stage where your income is naturally going to be high because you're going to reach your peak earning years. You'll be paying lots of taxes, and you're like, "Man, I just hate how I'm paying more and more taxes," and then you add the 3.8%, Medicare surtax on it. The last thing I'm trying to do is generate more taxable income, and that's what I kind of love about index funds. Is that index funds, by their nature, are very tax efficient. They don't generate a ton of taxable income because they're not turning over, so there's not a lot of capital gains. The companies with, I think the S&P 500 is yielding a little over 1%. And that is one of the things that I think is amazing when we hit bear market or recession. When you see that like the S&P 500 yield gets over 2 to 2.3%, you're like, hot diggity dog,
awesome.
because that means that's an indicator that the valuation is splendid and the water's warm. Let's go ahead and get in this thing. But it is one of those things where I don't go after dividend yields specifically for the income because I'm trying to minimize taxes. And I also think that you sometimes might let the tail wag the dog. That's usually said for taxes, but it's also from an income standpoint because, Bo, you've bought companies back when you were first starting to invest because you were so excited at how high their dividend yield was because
you were like, genius.
You liked that building. But the tax part of me hates how inefficient dividends are because corporations pay a tax on that income, and then you as the individual, when you receive the money, you also pay a tax on it. That bothers me, but that's here nor there.
Well, and one of the things that bother me about dividend investing is when it comes to like investment return, it's really comprised of two components. There is an income component and appreciation component. Well, a really well-diversified portfolio should likely have both of them. So I think when you focus solely on income investing, solely on generating that, you're leaving out a big half of the equation, which is capital appreciation. Rather, if you're trying to create a passive income stream, which is what I would argue the majority of our retired clients who have these large portfolios that they live off of, every month they have a deposit that hits their checking account. So they have passive income happening. Well, rather than that be dividends that are just paying and we're sitting the dividends through, we're managing the portfolio from a total return perspective.
Exactly.
We want to combine the income component with the capital appreciation component, and then we can define how much income or how much of a cash flow or how much of a withdrawal we send through to the client. If all you're doing, especially as a young person, focusing on the dividend piece of it, I think you're missing a big piece of what you could be doing from a total return perspective.
I feel like I'm like the elementary school teacher. I'm trying to walk everybody through the behavioral and stuff, but you just gave the right financial planner answer. And that's why we're a good team. It's just that we should have put your answer first and then let the old man wander in the woods with all the educational anecdotes that people might want to know about it. So that was a great answer.
Here's another thing that I'll throw out there. You said, Kyle, I love target retirement index funds for a young investor, as do we. We think that's a great solution until your portfolio gets a critical mass of $300,000, $400,000, $500,000 of investable wealth, and then you can really benefit from not only a different asset allocation, but also an asset location. If you're before that stage, if you're on your first $5,000 or your first $50,000 or even maybe your first $100,000, I wouldn't spend my time focusing on dividend component and income generation. I would do the easy set it and forget it, target retirement index fund, and rather I would focus on how can I save an extra $100? How can I save an extra $1,000? Focus more on your savings rate than your rate of return, and your future self will thank you, because that, especially for a young individual, the amount that you can save now at this stage in life is exponentially more important than your rate of return this year. Do the easy part on the investing part, figure out the harder part on the behavioral side. All right, this next question is from Denton, and I think this is a really good one, Brian, because I think you see, but maybe even more so than me, people struggle with this a lot. I'm 27 and have paid off all my student loans. I am investing 25%, and I'm even putting some extra toward the house. Can I buy a Rolex in good conscience? So here's his question. I'm a young guy, and I'm doing all the right things, and I'm saving the right amount, and I've paid off my debt, and I've followed the food to a T. But it's hard for me to justify rationally that I need a Rolex watch. In terms of me developing a lot of utility around it, is it okay for me to go do that? Is that something that we're going to, and we've heard this people saying, hey, well, is it okay if I go buy a Tesla? Or is it okay if I buy the beach house? Or is it okay if I fill in the blank on whatever the consumption thing is? Is it okay, and how do I find a peace with that? Or how can I be okay with that? Or how do I reframe my mind and maybe not have a peace with it because it's not okay?
This is a great question, Denton, and this is, and I have an experience share to put in on this too, is that first I want to go ahead and get to the short side of this and give you an answer, is that I think if you are a person 27 years of age, you've paid down all the high interest debt, you're saving 25% for investments, that act alone, once you've checked those boxes, I give you permission. It gives you the freedom, the flexibility. Go be happy with your money. Go build your best life, whether it's making memories by traveling, or even if it's buying a Rolex or buying that Tesla. I think that that's okay because you've gone through the financial order of operations. And look, and a Rolex isn't the worst thing in the world. I think I've shared with you guys, I own a Rolex. You notice I don't wear a Rolex. I still own the Rolex. It's actually appreciated. It's kind of crazy that I bought this thing, I think in 2007, and it's now worth more than I paid, even on the used marketplace. But the why's a little different now. I bought this. It was one of those things, and my wife kind of told me, you need to buy it, because I had a number in my head that when I started my company, once the business reached this level of annual income, I was going to reward myself with a Rolex. So there was a little sweetness on accomplishing that goal. But once I reached there, I was like, it's just like the Corvette I was going to buy it when I turned 25. I can reach these goals. I'm like, yeah, actually the journey was more fun than actually purchasing the good. So I don't actually do it. But my wife, was like, no, you need to do that one because you did it. And it's cool that it sits in my drawer and it has some sentimental, but it's just, I think I was so excited about looking the part of wealthy, which is funny to me, is now that I've reached this level of, I call it level 5 of the 5 stages of wealth, I don't care about that stuff as much now. But so it's fine. So if you understand your why, Denton, and this would bring you happiness and fulfillment, I give you permission. You can do it, and you're respecting the financial order of operations. But you'll find it's just another thing that you own.
Yeah, I would
that's
throw
the
out
way
there.
I look at it.
Yeah, it depends on your. I've got some friends, and they're just watch people. I know you have friends too that that's where they derive their utility. They like having nice watches. We have friends that are car people. They like having nice cars. I would really revisit the why. Do you want to have the Rolex so you can look wealthy and be flashy and show it off to folks? Well, maybe question your motives there. But if you just like nice watches and that's something that your goal is to have that, and that's something that is important to you, I think that's okay.
I think that's a good point, because because I do have friends that this is like their thing. Just like your car, you mentioned it, cars can be your thing. As long as the thing that brings you happiness doesn't derail your financial life, that's probably fine. I mean, we even had I had somebody write us a handwritten letter. I needed an email address so I could write him back. So if you get this and you want to know about the pens that I have, because you're a pen collector, so it's different things. Some people have that collector mentality. Sure. I've realized that I'm wired a little differently, and I'm not taking anything away from the Rolex. It's just that I think Bo nailed it. You got to know your why and what is the value you're expecting to receive after you make this big purchase.
Guys, we love getting to answer your questions. We love getting to do this show. If you haven't had a chance to go check out the website, go to moneyguy.com. We have a resource page out there where we have tons of deliverables where you can go look at our financial order of operations cheat sheet. You can look at our tax guide. You can look at how powerful are your dollars. If you've not subscribed to our newest written piece, FYI by FTE, Daniel's actually writing blog posts for us now. So if you haven't had a chance to check out his writing, make sure you go do that. But thank you so much for letting us be on your computer screen, in your earbuds. Is it earbuds? AirPods. My wife, I don't know which one it is. Be in your headphones. We are just so thankful we get to do that. Thank you for letting us be a part of your financial journey.
Guys, thanks so much. I'm your host, Brian Preston, Mr. Bo Hansen, Money Guy team, out.